one of the things that you're hearing for example, on economics Twitter is this phrase, we're all modern monetary theorists now. Can you talk a little bit about what modern monetary theory is, how it relates to the union of fiscal policy and monetary policy, and whether it's an appropriate policy response to this particular crisis we're in right now?
Well, modern monetary theory was a leftist idea supported by a bunch of leftist academics that essentially said, if you're a country that has your own currency and your own central bank, you can run large budget deficits forever, you can monetize them, and then you're not going to even have inflation. Now, that extreme view that you can run it forever under good times and bad times, even at full employment, and you can monetize fiscal deficit, doesn't make sense. But in a situation in which you have a collapse of economic activity, you have recession and deflation, and there is a collapse of velocity, we learned that lesson during the global financial crisis. You can do a variant of modern monetary theory. Budget deficit and the way you monetize them is through QE. It's not officially modern monetary theory, but essentially is a variant of it. And you avoid the deflation and you avoid the deep recession. So used to be called MMT, modern monetary theory, or used to be called helicopter drop of money, meaning the government spends by issuing bonds and the central bank gives the government the cash, and then literally you drop it on people, like transfer it, like what we're going to do with the checks right now. Used to be called also people's QE by UK Labour. It was labeled as a leftist idea, but guess what? Has become mainstream. People like Ben Bernanke, former Fed chairman, Stan Fischer, former vice Fed chair, who together with Philip Hildebrand, that used to be running the Swiss National Bank, is now at BlackRock, the biggest asset manager in the world, that come up with a proposal for an idea that is a variant of essentially helicopter drop. Ray Dalio, Adai Turner, Willem Bouter, pretty much mainstream economists. I wrote extensively about the idea of MMT for the next recession already literally a year ago. And I said, when the stuff is going to hit the fan and we're going to have the next recession, zero rate is not going to be enough. Negative is not going to be enough. Forward guidance, quantitative easing is not going to be enough. We're going to go to MMT. And guess what? It happened in less than a month, literally, because the way they talk about it right now, Bernanke or Dalio, is not MMT, is not helicopter drop. They call it coordination of monetary and fiscal policy. What does coordination mean? The Treasury is going to issue $2 trillion of bonds, notes, and bills to finance this budget deficit, additional budget deficit, on top of the initial trillion, and the Fed is going to buy every single note, bill, and bond issued by the Treasury. That's what's called coordination, right? But what is it? What's the difference between coordination and helicopter drop, or between coordination and QE with a fiscal deficit? It's close to zero. In the case of deficit and QE, you're buying the bonds in the secondary market. The government sells it to the market, and then the Fed buys it for the market. When you do MMT or monetary financing or helicopter drop, you're buying it directly in the primary market. But the impact on long-term interest rate is the same. Who cares whether the Fed buys it at issuance or a month later? Substantial doesn't make any difference. Even large deficit and QE is effectively MMT, whether you call it that way or you call it something else, or euphemistically coordination of monetary and fiscal policy. It walks and quacks like a duck, is helicopter drop. That's what it is. And we're going to see massive helicopter drop. Now, the point that I made, however, is the following one. In the short run, doing helicopter drop makes sense. Makes sense because we have had a collapse not only of supply and disruption of supply chains, but we also have had a collapse of demand. So we've had recession and right now deflationary pressures. And therefore, doing a massive fiscal stimulus and monetizing it makes sense when you have staggered deflation, recession and deflation. That makes sense in the short run. But as people say, you can fool some of the people all of the time and all of the people some of the time, but you cannot fool all of the people all of the time. Suppose that you are in a world in which these budget deficits of 10% of GDP fully monetized occur not only this year, but actually in a downside scenario, we might have them next year and the following year.
Right.
In the short run, we have a demand shock more than a supply shock, and that's the way you fight it. But think about this shock. Over time, this is a negative supply shock that reduces output and potential output and increases costs and essentially the production cost and the prices of every type of goods and service. The disruption of global supply chain, soon enough, we're not going to have enough farm workers in California to pick up the fruits and the vegetables. Over time, what this shock is going to lead, it's going to lead to an exacerbation of the decoupling between US and China. Even before that, I wrote last year, and before we had a Cold War, we have Thucydides trap, we're going to have deglobalization, we'll have decoupling and fragmentation. All these trends are going to be emphasized. More decoupling, more deglobalization, more reshoring, more fragmentation, more balkanization of the global economy, more tariff, more protectionism, more defending your own firms and your own workers, more inward policies, more restriction to trade in goods, in services, in labor, in capital, in technology. This is a massive negative supply shock to the global economy. You monetize it and you fiscalize it for 2 or 3 years. Eventually, you end up into not deflation, but in stagflation, recession, and inflation, like the 1970s. Look what happened in the 70s. We had 2 oil shocks, 73 Yom Kippur, 79 Iranian Revolution. We reacted by trying to boost economic growth. We had deficits and monetization. Through easy money, we ended up with double-digit inflation and stagflation. By next year, we can be in stagflation, the worst of all worlds, high inflation and recession. That's what gets us to a depression, not just a recession.
Nouriel, one of the things that I found so interesting is someone who's followed your work very closely. You wrote in a Project Syndicate piece, and I think it's probably worth quoting here. Moreover, the fiscal response could hit a wall if the monetization of massive deficits starts to produce high inflation, especially if a series of virus-related negative supply-side shocks reduces potential growth. One of the things that's been very interesting for people who have followed your work, during the Great Recession, you talked about how there was a collapse in the response to the Great Recession, how there was a collapse in the velocity of money, and that we didn't see these inflationary pressures building. This is a significant shift from that position. Perhaps you could talk a little bit more about what it would look like and how we would start to notice that risk case coming online.
Well, the global financial crisis, I analyzed it, was a credit shock that led to a collapse in aggregate demand. You had a big output gap, slack in goods and labor market. You had wages going down, prices going down, deflation. And therefore, if you did effectively MMT, that's what we did through the back door through QE and deficits, you're essentially avoiding that recession from becoming a depression with deflation. That was the right policy response because there was a collapse of aggregate demand and there was a huge output gap. Today is different. The type of shocks that are going to hit the global economy are all negative supply shock. As I pointed out, the coronavirus, the breakdown of global supply chain is going to get worse. I fear that we're not going to be able to produce food. That in many parts of the world, as the crisis become worse, food workers and the food supply chain is going to be disrupted. If you cannot produce food, then you'll have a shock to food prices. I mean, look at what happened in China. You had a small shock that was last year, the swine flu, and the swine flu alone led to production of pigs to collapse by 50%, that to kill all of them, and price of pork went up 100%. This was just a little tiny swine flu in China. Think about how these pandemics can disrupt a global supply chains around the world, and especially food supply chains. That's a huge negative supply shock. And after the crisis, decoupling between US and China is going to get worse. The US is blaming China for this. China is blaming the United States. If we had the Cold War before, if we had the Thucydides trap on technology, on trade, on services, on finance, on currency, it's going to get worse. Look at the rhetoric between the two sides. So we'll have more balkanization, more decoupling, more deglobalization, more reshoring. That's costly because instead of producing in the lowest cost parts of the world, we're going to produce them expensively at home. That's a massive negative supply shock. Trade wars. In the 30s, the Smoot-Hawley tariff led to the worsening of the financial shock and led us to the Great Depression. Now we're starting trade wars with China and the rest of the world. They're going to get worse. Everybody's going to say, I'm going to protect my workers, my firms, my tariffs, and so on. That's a recipe for a negative supply shock becomes global. We're not even sharing medical supplies. Every country wants to have their own ventilators, their own masks. At home, we're not even letting export of these things across country. This is the beginning of restricting trade in goods, in services, in capital, in labor. Trump is going to say, I was right bashing China. I was right to build the wall. Guess what? You can build any wall you want to with Mexico or Canada, but the disease is going to be beyond the wall. It transmits regardless of whether you have a wall or not. This is the nature of global pandemics. So the supply shocks become global. And I'm not yet at the point where there'll be other supply shocks. I really worry there'll be a war between US and Iran this year in the Middle East. And we'll have another supply shock on oil prices like we saw in 73, 79, or 1990. That's still to come. That will be another huge supply shock. So we're going to be going in a world where most of the shocks are not aggregate demand, but their nature is negative supply shock through essentially deglobalization, pandemic, oil shocks, protectionism, nationalism, and inward policies. In that world, you have essentially the condition for stagflation, recession and inflation like the 70s, because, as I said, if it's a demand shock like the global financial crisis, you monetize, you fiscalize it, you return to growth. But if it's a negative supply shock, you monetize it, you fiscalize it, and eventually you end up at stagflation. Now, we're not bad enough to end up like Zimbabwe or Venezuela or Argentina with hyperinflation. Even if advanced economies after World War I, like the Weimar Republic in Germany, had hyperinflation, or Hungary. Those things can happen if you have a total collapse. If we get a depression, and in this depression, we're going to run budget deficit, print them, we may end up like Hungary or Germany during the Weimar Republic after World War I. We could get hyperinflation. I don't expect that to happen now, but certainly we could get stagflation with rising inflation and recession like the 70s if we keep on kicking the can down the road and stimulate the economy if the persistent sets of negative supply shock keep coming and coming. That's not a risk this year, but by next year or 2 years from now, that will be a meaningful rising risk.